Think about the blue flame under a pan, or the heat that kicks on when a room gets cold. You probably don't think about where that gas came from, who owned the rights under the ground, or who gets paid when a producer drills. WhiteHawk Minerals lives in that hidden layer. WhiteHawk Minerals Corp., ticker WHK, is not trying to run gas stations or drill wells itself. It owns mineral and royalty rights across major U.S. natural gas basins. In plain English, other companies do the drilling, and WhiteHawk gets paid when gas is produced from land where it owns the rights. So here's the question for the cursor stocks today. What would have to be true for this IPO to actually make sense? Is WhiteHawk a steadier way to collect from natural gas production? Or is it still mostly a bet on gas prices with a nicer story around it? The business model is easier than it sounds. Imagine someone else pays to drill, hire crews, handle equipment, and deal with the messiness of production. WhiteHawk's role is closer to owning the rights that sit underneath the activity, then collecting royalty payments when producers pull gas out of the ground. That difference matters because drilling is expensive and risky. A producer can spend heavily before knowing exactly how much a well will deliver. WhiteHawk says its approach is capital light, meaning it doesn't need to carry the same drilling budget to participate in production. That sounds powerful. But there's a catch. The IPO, meaning the moment a private company starts selling pieces of itself on the stock market, has already happened. WhiteHawk began trading on the NYSE on June 9, 2026, under WHK. It sold 7.7 million shares, tiny ownership pieces of the company, at $26 each, raising about $200.2 million. A company goes public for a few ordinary reasons: to raise money, give early backers a path to sell over time, and get more visibility. For a royalty company, public money can also help fund the next round of mineral rights purchases. In other words, more rights could mean more future royalty checks. The headline that will catch beginners is the dividend yield. At the IPO price, reporting put WhiteHawk's yield around 7.7%, compared with roughly 1.1% for the S&P 500. A dividend is cash a company pays shareholders, so that number sounds tempting. But a high yield can also be the market asking, can this last? This is where the blue flame thread comes back. WhiteHawk is not paid because you personally cooked dinner. It is paid upstream, where gas is produced. If enough gas keeps flowing from its acreage, the royalty stream can support dividends. If volumes or prices disappoint, that comfortable-looking payout gets harder to trust. Management's pitch leans on risk control. According to reporting, WhiteHawk had hedged about 90% of its commodity price risk over the next 12 months and about 80% over the following 12 months. Hedging just means it tries to lock in some price protection so gas price swings don't hit all at once. The bull case starts with need. Natural gas is still a major fuel for heating, power plants, and industry, even as renewables grow. If producers keep developing the acreage where WhiteHawk owns rights, WhiteHawk can collect without making the big drilling decisions itself. That is the attractive part of the story. The names sending royalty checks also matter. Reporting named large natural gas producers, including EQT and Expand Energy, as companies that pay royalties to WhiteHawk. For a beginner, the takeaway is simple. WhiteHawk isn't waiting for tiny unknown drillers only. Some of the activity comes from major operators with real production footprints. But the first reality check is just as simple. WhiteHawk can avoid drilling wells, but it can't avoid the energy cycle. Gas prices move. Production schedules change. Operators decide where to spend. So the company may own the rights, but it doesn't fully control how much activity happens above them. Now look at revenue and profit. Revenue is the money coming in before expenses. Profit is what is left after the bills are paid. In 2025, WhiteHawk brought in about $67.6 million of revenue and lost about $3.6 million. That loss is not enormous next to revenue, but it still matters. There is another wrinkle. Reporting says WhiteHawk recently restated financials because management found certain material accounting errors. That doesn't automatically break the business, and the CEO said dividends were not affected. But for a new investor, accounting cleanup is a yellow flag. You want clean numbers before you trust the story. Competition is not only other companies chasing gas. It is also other stocks offering investors a royalty-style way to play energy. Public names like Viper Energy, Kimball Royalty Partners, Blackstone Minerals, and Permian Basin Royalty Trust give investors comparisons. WhiteHawk has to earn attention against that shelf of alternatives. The valuation tension is a little different here because the clean headline is the cash raised, not a neat whole company price tag. Remember, $26 is just the price of one share, not what the entire company is worth. The real test is whether future royalties and dividends make that share price feel reasonable. For beginners, the use of money question is practical. Does the IPO cash make the business stronger, or does it mostly help existing owners exit? With WhiteHawk, the obvious thing to watch is whether public company cash helps it buy more mineral rights without overpaying. Growth by acquisition can work, but discipline matters. Now that it's trading, watch 3 plain signals. First, do royalty volumes keep supporting the dividend? Second, do losses shrink or turn into profit? Third, do acquisitions add better cash flow, not just bigger acreage? Those answers matter more than the opening day stock move. So what would have to be true for this IPO to make sense? Gas demand needs to stay healthy. Operators need to keep producing from WhiteHawk's acreage. Hedges need to soften price swings, and management needs to prove the dividend is backed by real cash. That's a lot, but it's understandable. The dream is easy. WhiteHawk collects from gas production while others do the drilling, then sends a meaningful dividend back to shareholders. The doubt is easy too. Gas prices, accounting trust, and acquisition discipline can all change the story fast. This is not magic income. It's a royalty business with real risks. Next time you see that blue flame, you'll know there can be a long chain of businesses behind it, from drillers to mineral rights owners to public shareholders. That's the point of the cursor stocks. Make the chain readable before it feels intimidating. This video is for information and education only, not financial advice.